Hey guys, welcome back. Patrick here. I have to thank some of the viewers that made me aware of some big changes by the SEC this week, which I feel are going to affect the SPACs in the future significantly. So I felt, hey, today let's have a discussion about this and we'll talk about how it's going to impact you in the future as a SPAC investor. So first, I'll go into what the changes are and how they work. Like, what is it exactly that they're trying to fix? Second, how is it going to impact your current SPAC positions? Should you be worried? Like, how should you handle this? Third, how do I think it's going to affect the SPACs in the future? Like, what's going to change from this decision? And fourth, what am I going to do about this? So let's get started right now. But first, of course, I have to ask you, please like and subscribe. It really helps out. It's going to be your good deed for the day. So let's get started now. So what is the SEC up to now, and how are they going to mess with us small SPAC investors? So first, we have to talk really quickly about how companies go public and raise money. So traditionally, there's only three different options that they have. First is to go through the IPO route, and that's not seen as a very good option for a lot of companies because it's very expensive, takes a lot of time, there's a lot of filing requirements, and also bankers and attorneys make a ton of money off of the back of the company through fees. Plus there's also the very inaccurate pricing. Let's say that they price the company at $20 a share and then the share price goes to 40 because it's popular. Well, the company only gets that $20. Investors are the ones collecting that extra $20 in profit. Well, so a lot of companies feel like they're getting shortchanged, right? They need that money to fuel their growth, and they're not getting it. So they feel like IPO isn't always the best case. And the other alternative is the direct listing, which, as far as I know, is what Airbnb and Palantir are doing right now. But the drawback with the direct listing, which lets you go public, right, and you sell shares that the company already has, so it doesn't create new shares. But because of that, you can't raise more money. So it's good for companies that don't need money, but for a lot of the smaller ones or companies that are in growth mode, well, they need that capital to expand. And that's why SPACs became so popular. Number one, they're quicker, they're less expensive, and they have that management from the sponsor that often can actually help the company grow. And then you have that guaranteed money, almost, right? In trust, they often have hundreds of millions of dollars, and the merger target knows that they'll be getting that money. So that's a big incentive, and that's why they've become so popular this year. So what happens then? Well, we got the New York Stock Exchange, which is of course is going to be followed by the Nasdaq very soon. That figured, hey, we have all these companies that are trying to get on the stock exchange through the back door with a SPAC, and why don't we just let them do a direct listing, raise money from shareholders, and that way it's the best of both worlds. So not only are they happy, right? They get on the stock market, they raise money, but also we cut the middlemen. We don't need those SPAC sponsors. Well, that's got a lot of people worried about what's going to happen with our current SPACs and what's going to happen with SPACs in the future. So that's what we're going to be talking about right now. The fact that companies now are going to be able to not only go on the stock market as they want and actually raise money, well, then what's the role of the SPACs anymore? Like, how is that going to affect them? Are they still relevant? So I've seen a lot of chatter online about, well, what's going to happen with the current SPACs? Like, what happens with Hyliion, LCA, OPES, Lordstown, a lot of our favorites that we have currently. Are they going to just like drop the current merger agreement and go do their own direct listing? Because if all they want is to get on the stock market and raise money, well, why would they go through a SPAC now? All they have to do is do a direct listing, get the money, and now they save all this equity from the sponsor, right? They have to give the sponsor shares 20%. So why would they do that if they can do their own direct listing? Well, remember, disclaimer, I'm not your securities attorney. I know I look very professional, right? I'm very proud of that, but quick disclaimer, you're informed. This is just my opinion and my interpretation. So in my interpretation, nothing's going to happen with these companies. Like, let's face it, they're almost at the end goal, right? They're almost at the goal post. They have 1 or 2 months away from the merger. So they have money coming in, they have a definitive agreement signed, right? They're not really sexy SPACs. I'm sorry to say, like as much as we like Hyliion and all of these other companies, like with the general public, they don't have brand name recognition. Like if you talk about Airbnb, the guy on the street is going to know what Airbnb is. If he goes on his like brokerage and he sees that Airbnb is doing a direct listing, he might want to buy shares. But if someone says, BurgerFi is going to get listed, the man on the street doesn't know anything about BurgerFi, right? So there's a select few of us that are SPAC investors that are really paying attention to these companies, and we know everything about them, but they don't have very much brand recognition. So nothing says that if they went on the open market, they wouldn't get the HOFV treatment and be totally hated by all investors and not be able to raise almost any money, right? Instead of raising 3, 4, $500 million, maybe they would have raised 50 million or 100 million, and then they would be in worse shape than by going through the SPAC. So this is my point: is these companies are in a deal right now. They negotiated it, they know what they're getting into, and they're happy with it. Everyone benefits from these mergers going through. In fact, you have people that have taken it a step further and contacted the management team of some of the SPACs to have an answer about this. So you have this guy that emailed Stefan Pang, which is the CFO and director for Tortoise Acquisition Corp, the company that's merging with Hyliion, and the guy says, "We do not expect this ruling to have any impact." So this is exactly what I suspected, right? I disagree with bombarding them with emails about this. I mean, it was so obvious that they weren't going to change their entire plans 2 weeks or 3 weeks before the merger based on this decision. But with that said, now there you go, guys. You have confirmation. This isn't going to affect Hyliion. It's probably, I mean, it's not going to affect the other companies either. So everything is going to plan. For your current SPACs that you have now that are about to merge, right? There's no big problem there. So before I take my crystal ball out, I just have to mention where we are now. I feel like right now we were in a really good spot. Now, this decision is going to open some new doors, but it's going to close some of them when it comes to the SPACs. And this is what I mean by that. Right now, I feel like we were in a really good spot. The SPAC quality has improved tremendously over the past few years. If you think about the previous years, I mean, they were considered basically fee schemes for sponsors. The sponsors would make money, the bankers, the attorneys, but the shareholders, no one cared about them, right? More than half of the SPACs were losing money and trading under their IPO price after the merger. So they were bad. But now in 2020, they've improved significantly. We got much, much, much better quality in SPACs. Less MJ stocks, less foreign companies, and better companies that have products, revenues, or at least a lot of potential. If you think of a company like Goris Mitropoulos, the SPAC, that's going to be merging with Luminar. So yeah, Luminar right now is losing money, but it's a future tech company that you can expect in a few years is going to dominate their industry. So a really good sports analogy is that right now we've been dealing with a lot of first round draft picks. If you think of a company like DraftKings, I feel like it's a very good, strong company for the long term. Well, we could have gotten in at $10 like most SPACs. So there was some gems in there. And my point is that in the past few months, SPACs have been getting bigger and better. If you think of a company like Pershing Square Tontine Holdings by Bill Ackman, that is going to raise up to $7 billion and has a very good structure, which you can see in the description in my review. I mean, those are companies that I had a lot of faith in was going to give us some really good opportunities. But I feel like those are going to be affected by the current decision. So what happens next? Where do we go from here? Well, I feel like the landscape is going to change. Some of it is going to be very positive and some of it's going to be very negative. First, I think that most small spec plays are still going to go with SPACs. So nothing's going to change there for us because they need that guaranteed money up front. So it's a structure that's very good for them. Plus, we usually talk about the company that's being acquired, but the sponsor plays a big role. Not only do they bring them expertise because they're going to be putting a member on the board, but also they bring a lot of marketing to the company. A lot of these companies, we don't really know them that well. We've never heard of the CEO before until they actually announce a merger, and that brings a lot of interest into that stock. As for the bigger companies, I feel like this is where the positive momentum I was talking about is dead in its tracks because they were getting bigger and better, but now they have an alternative that's as efficient and as attractive as it would have been before going through a SPAC. Now they can go on the stock market, they can raise money, and there's not going to be necessarily that discount because now the market's going to dictate the value of the company. So all of the money that they raise is what the public say that they're worth. Well, what do we know from SPACs? We know that often our sponsors have a lot of leverage on the companies that they've been negotiating with. If we think about DraftKings, if we think about Hyliion, if we think about, I mean, a bunch of them, right? Right now, FMCI, right? The SPAC price starts at $10, but already the market price is at 17, and by the merger it might be higher. DraftKings went from 10 to 40, Nikola 10 to 40. So my point is the sponsor has a lot of leverage and more negotiating experience than the CEO of these small companies. So often they can kind of get a sweetheart deal that you're not going to get from companies that are listed straight on the market, and we investors, by buying into it, dictate what the value is. I hope you get my point here. I feel like this is going to hurt tremendously for those bigger SPACs. If you think about Pershing Square Tontine at 7 billion, if you think of Churchill Capital 4, I think at 1.7 billion, all of those 1 billion plus companies, their pool of targets just shrunk tremendously and their leverage just shrunk tremendously. So this is going to apply for all SPAC. That leverage shrunk tremendously. Now, a lot of companies have an alternative, which they didn't have before. This is going to make things a little more tight for us SPAC investors. There might not be as much meat around the bone. So, despite all of that, I still find some positive in this situation. And the main thing is that the best sponsors, the guys that are the best managers, are going to be worth their weight in gold. Right now, there's so many SPACs out there. Is everyone and their mother wants to start a SPAC, and not all of them have actual expertise. All they do is bring money to the table. That's great, but now these companies can get money a different way. But the companies that have really good sponsors that are going to help the company grow quicker, well, that in itself is very valuable. Think about a guy like Bill Ackman. I mean, I'm worried about Pershing. I think that it's the company that's threatened the most by this. But at the same time, if you think about him and his team, they have a very strong team. And if you put that guy on TV, like put him on CNBC, that guy's going to pump your stock like crazy. You guys know him, right? He's a magnet for cameras. So that has value in itself. So you can't discount that. The ones that have really good sponsors are still going to be attractive for some bigger companies too. So in the close, how am I going to be playing this? How is it going to affect my strategy? Well, first, I'm going to pay more attention to companies that have letter of intent signed. In the past, a strategy I used and other SPAC investors used was to go for experienced management teams. If they had raised hundreds of billions of dollars and had connections in the industry, the likelihood of them finding a target was fairly high. So then the strategy was wait until they find a merger agreement target and then the share price and the warrants are going to go up, then you can cash out. But I feel like this strategy is going to die off a little bit. There's just too many SPACs in the market right now, and the risk versus reward is shifting. The risk is increasing and the reward is going to shrink. So for me, that strategy is not going to be as valuable as before. I think it's going to be better to analyze companies that actually have deals that we can look at. So number two, I'm really going to focus on first round draft picks, the best companies that I can get in these SPACs. So before I would take a flyer on some of them, but now I feel like the quality is going to drop significantly. Not only because the better companies are going to go for a direct listing themselves, but also because some of the better companies have already been picked, right? So now we're going down the line. If we think about EV companies, for example, well, you got Hyliion, you got Nikola, you got Canoe. Well, now eventually you might have Proterra. But once you get to the sixth or seventh or eighth, right, the companies are going to get worse and more speculative. So for me, I always want to pick a company that can dominate a market, not a company that can be third or fourth best. So I'm going to make sure that the companies I pick haven't been cherry picked to death where all that's left is the scraps and I buy it just because it's a SPAC. Last but not least, I'm going to focus on sponsors that bring more to the table than just money. I feel like all the Wall Street guys can do that, but what's going to be more valued now are those that are going to be bringing expertise that's going to help the companies grow quicker. And that's going to be the value add from the SPACs that they won't be able to get just from going straight to the market with a direct listing. So I feel like those guys are going to get better deals, so I'm going to pay more attention to that. So that's it for today. Let me know in the comments what you guys think about this SEC decision, and is it going to impact your strategy now coming up with the SPACs? Let me know. I can't wait to read your comments, and I'll see you guys in the next video.